Hi, everyone. I'm Ivan Buyuki, and welcome back to Wall Street Silver. Our guest today is the one and only commodities investing legend and the founder of Rule Investment Media, our good friend Rick Rule. Rick, it's great to see you.
Ivan, thank you for having me back. It's always a pleasure.
Yeah, it's always a pleasure having you on. You've said in a recent interview that normally bull markets are brought on by fear buyers. With higher inflation numbers being posted, when will we start to see the fear buying pick up in precious metals?
Note that I said precious metals bull markets are brought on by fear buyers. First of all, other asset classes respond less to fear.
Yeah.
But now to your question, if past is prologue, in the 1970s bull market, given that metals hadn't moved for a very long time, it probably took 2.5 or 3 years of experience of inflation before the fear associated with inflation set into generalist investors. And I would suggest that we experienced the same thing in the 2000 bull market, meaning that the conditions precedent for the bull market were expressed in the market for a full 2 years or 2.5 years before the market itself responded. The market that we're in right now, I think, has experienced probably 40 years of benign climate, which is to say declining real interest rates, increased availability of liquidity. And the consequence of that is that people don't fear inflation. They don't fear disintermediation, and they don't fear the potential impact on the pricing of other savings and investment products that would occur as a consequence of higher interest rates. I myself believe that we're in a circumstance where faith in the economy and faith in the government remains very high. I do believe, however, that the reality of the depreciation of the currency that has thus far been acknowledged by the authorities, the 6.5%, relative to the nominal interest rate paid on savings products, 1.5%, as an example, in the US 10-year Treasury, will provoke a circumstance where ordinary savers look at the returns they get on conventional savings and investment products and understand that they need to defend themselves. Of more use, Ivan, I think, is the fact that fixed income instruments, bonds as an example, are increasingly an untenable part of the portfolio of the largest institutional investors in the world. It's a generalization, but a mostly true generalization, that for 40 years, the largest institutions in the world have run portfolios that were 60% equity, 40% debt. If 40% of your portfolio is generating a negative real rate of return, and you are responsible for the well-being of pensioners 20 years from now, or the operation of the Stanford University 20 years from now, or a sovereign wealth fund 20 years from now, what happens is that a full 40% of your portfolio isn't responding. And you need to make some changes. And it's precisely the disintermediation out of debt securities by the largest institutional investors in the world that I think will kick off the precious metals bull market. I think our retail people will be important, but I don't think they'll be anywhere near as important as the largest institutional investors in the world.
What you just said there, inflation hasn't been long enough. And that's what I picked up right at the beginning of your statement. Inflation rising again now is sort of new to the market. We've had two generations of Wall Streeters probably come, now in the system who have never experienced real serious inflation. And they're buying maybe this narrative that it's transitory still. I mean, do you really think we need to have like another year of these 7% CPI numbers before they get it?
I absolutely do. People's experience from 1982 to present has been different. And people have a wonderful thing to blame everything on right now. The big thinkers at least do, COVID. I was on an interview not too long ago, a Q&A interview, where the questioner actually said to me, the higher prices that we're seeing in oil and gas due to COVID. And I had to say, what? How on earth has the virus increased energy prices? It seems that one of the narratives around us today is that all of the economic dislocation that we face is due to COVID. The idea that it wasn't due to, say, a higher cost of capital or decreased sustaining capital investments in the energy business seem to take second peak to COVID. I think that as normal people look at the fact that their bank account is generating 25 basis point or 0.25% return, if it's generating a return at all, while the purchasing power of the principal of that account is declining by 6.5%, while it may not generate a fear of inflation, will certainly generate a behavioral change around investing, taking into account the depreciation of the purchasing power of the dollar more and more and more.
So, Rick, it sounds like from what you're saying, there's this argument out there. There's an inflationary argument versus a deflationary argument. And I guess the deflationist point of view is this is all transitory. It's just COVID related. This is all temporary, and inflation is going to naturally come back down without having to raise interest rates, without having to take the pain of the Fed changing monetary policy. What is your take on that? Has the deflationist argument imploded at this point?
Theoretically, in a free market, the circumstance that we see is deflationary, which is to say there's too much debt in society. We need to liquidate debt. You liquidate debt through a cessation of borrowing and through a default cycle. So left to our own devices, the circumstance that we face is extremely deflationary. Deflation, however, is politically incorrect. The voters, to the extent that they have the choice, won't tolerate it. The voters would much rather face the consequences of their actions over 20 years than face them over a year and a half, meaning that the political class will do whatever they can to forestall the debt cycle. And the truth is, as we have stated earlier, investors have been trained over the last 40 years to expect a fairly benign outcome. And benign expectations are not the stuff of deflation. They are the stuff of inflation. So the odds are, given the extent to which the political process and confidence runs the economy, that the outcomes will be inflationary, meaning that the deflationary cycle that would result from an economy telling itself the truth around the unsustainability of current debt levels won't occur.
That sort of plays into the argument, will the Fed, if you read their statements of what the Fed, it seems like in the past week, all the voting members of the Fed voting the board have been coming out with these statements of not only are they going to reduce the taper to zero, raise interest rates 3 times, but also I've been hearing lately, they're planning to reduce the balance sheet also, all 3, sell off the portfolio. And it just strikes me as completely irrational that they think that's not going to completely implode the economy. And I'm not really sure how to take this. Are they intentionally saying these things, or it's like they're all on the same script? Have you noticed the same in the past week? These statements coming out of them?
Yeah, I don't pay very much attention to what they say. I'm now 68 years of age, almost 69. This would not be the first time that the political class has deliberately lied to me.
Politicians lie?
Yeah, that's something I've seen. I think they'd like to do all these things. I think that the strength that they're seeing, the relative strength that they're seeing in the economy surprises even them. And I think that they understand that to the extent that they can discontinue tapering, that it will increase confidence in the economy. Right now, the economy is ostensibly strong. I think that they need to let interest rates rise because they need to have a fiscal tool to use when, as, and if the economy slows down. And it's very difficult to cut rates sub-zero, at least nominal rates sub-zero. And I think, too, that to the extent that the economy allows them to shrink the balance sheet, that the increased measure of confidence that would give the economy would be a spectacular jolt. So I think that they would like to do all 3. I don't believe that they have that much room. I would love to be wrong, Jim. Probably nothing in the world would make me happier than to have my precious metals thesis be fallacious. I could make lots of money in the rest of my natural resource portfolio if the world returned to, the sunshine and roses. It's just that I don't believe that that offer is realistic for me to expect. Let's look at the arithmetic as an example behind an interest rate rise. I hate boring your listeners with arithmetic, but I think it's important to rely on fact when one makes statements.
Pictures. We need pictures. There's no math allowed. Yeah, but go ahead. The floor is yours.
Using the US 10-year Treasury as sort of the guide, they pay you 150 basis points over 10 years in a currency where the purchasing power of your savings is declining by 650% a year, meaning, basis points. So they're guaranteeing that you're going to lose 5% a year. It's not very attractive. Continue this out. Traditionally, looking back over 40 years, the US 10-year Treasury has offered up a positive real rate of return, meaning if the currency is depreciating by 6.5% and you reverted to mean, the US 10-year Treasury would have to yield 7. Can you imagine the impact on the federal government with a $3 trillion deficit and $23 trillion in real on-balance sheet liabilities? Or the impact on state and local governments if the interest rate that they paid on their outstanding balances increased by 400 or 500%, which would be indicated by an increase in the yield on the US 10-year Treasury from 1.5% to 7. More challenging, I think, Jim, is that traditionally the US 30-year fixed mortgage rate has been at a premium to the US 10-year Treasury. So if the Treasury offered a real rate of return at, say, 7, that would suggest that the 30-year fixed mortgage rate would have to rise to 7.75 or 8. What do you think would happen to the broad economy if you quadrupled or quintupled the interest rate that is paid on the outstanding debt through society? I don't think that the economy as we face it today could face real arithmetic in a historic sense. And so irrespective of what the big thinkers say, I think they'll be constrained by the economic reality of the trap that they have built themselves, or we have built them by our expectations over the last 40 years.
Exactly. I mean, I would expect mortgage rates for a 30-year fixed mortgage to, if the 10-year was at, let's say, 6%, which I think is unfathomable to most people. What are we at now? 1.7, 1.8 something percent. But a 30-year fixed mortgage would rise to what, 8 or 9% for someone with excellent credit. I mean, what would that do to the housing market? I mean, everyone would collapse by
everybody
50%.
wants affordable housing, Jim. They just want somebody else's house to be affordable.
Yeah. Well, there's a funny joke going around that, it's a meme of millennials are all hoping for a collapse in the housing market so they can actually buy in. I want to get to your favorite investment right now. You're well known for your comments on uranium, silver, gold, and other commodities. Do you think there's one in particular at this moment in time, we'll call it middle of January 2022, and don't worry if you're wrong, I'll delete this video, so there will be no evidence. What is your favorite commodity right now and why? And don't feel an obligation to say silver because it's our channel.
No,
give us your honest opinion.
With the caveat that I'm an old, fat, bald, rich guy, my favorite investment right now is oil and gas.
It's very ESG wrong.
Yeah, very ESG unfriendly. That's one of the reasons why I like it, of course. But it looks to me like the public equities in the oil and gas space are discounting $45 oil, which is interesting arithmetic in a $70 world. It would seem too that they're discounting $2 natural gas in a $5 world. The oil and gas companies are generating tremendous amounts of free cash flow, but despite that, many of them are not making the sustaining capital investments that are necessary to maintain production. Those companies that are, I think, will continue to enjoy a surprisingly robust product pricing environment because other people aren't making their sustaining capital investments at the same time that they're generating so much free cash that they're going to feel an obligation to give some of it back to its owners by way of either dividends or share purchase buybacks. So while I look at the speculative upside around uranium, gold, and silver, and particularly the equities in those spaces. My favorite asset class myself is an investment class rather than a speculative class. And that has to do with the oil and gas business.
Well, we're Wall Street Silver, so I just got to ask: do you have a favorite uh, silver explorer, or junior producer, or major producer that you want to mention right now? I mean, if someone were just entering this space and thinking, I want to, after buying their physical silver, which silver stock is appropriate for that type of investor right now?
I would say perhaps the highest quality one is the Russian polymetal. If you looked at balance sheet strength and the quality of their physical assets, the one I like the most is different. The one I like the most is Pan American Silver. It is depressed because I think they underestimated the impact of COVID on their producing operations, and they've missed 3 straight quarterly estimates. So they're in the penalty box for that. In addition, they're depressed because of political changes in both Peru and Mexico. What I like about Pan American Silver is the continued presence of the founding shareholder, Ross Beatty, who at last report owned 12% of the company. I love adult supervision. And I particularly like adult supervision from people that I know and love and trust. In addition, in Pan American Silver, you have 2 upsides that aren't in the market. One, Navidad, which is a 500 million ounce high grade deposit in Argentina that they have not yet been able to put in production. The second is the silver deposit in Guatemala, the name of which temporarily escapes me, that they bought from Tahoe, another 500 million ounce high grade deposit that isn't in production. I believe that Pan American Silver, through their community development efforts, will be able to place one or both of these deposits in production in the next 3 years. Placing either of them in production would double their production and probably triple their free cash flow. And I get the upside of that, not reflected in the share price at all.
Our channel is all about precious metals, silver, to a lesser extent, gold. But in order for us to be right, a lot of things have to go wrong, correct? It's not like we're cheering for these things to happen, but we invest planning on them to happen because we think they're likely to happen, correct? But if we're right, it means a lot of things are going to go bad. I don't, like The Big Short. I don't know if you remember that movie. It's like, don't dance, right? Just don't dance. It's a lot of people become unemployed if what we think is going to happen in this debt cycle happens, the fear cycle. How do you think about that in relationship to planning for this cycle that we think is going to happen?
Well, Jim, it's the most important question you could ask, frankly. Too often in constituencies like the constituency that you and I share, there seems to be an eagerness to experience the set of circumstances that would kick off a manic precious metals bull market. And those circumstances, I guarantee you, would be universally bad. The circumstance where there was a credit default cycle, the circumstance where there was hyperinflation, the circumstance where fear of an economic unwinding of a 40-year bull market generated a 50 or 60% decline in equities markets. Those circumstances in every case are horrific. We as a society face a challenge that we have become dependent on involuntary contributions to each other through government to make up for the fact that probably 20 or 30% of American workers don't generate sufficient utility that they can be paid a living wage. Wages, money comes from the fact that you produce a good or a service efficiently enough that it provides enough utility for somebody that they willingly buy it from you. And a substantial proportion of the Western workforce, including the American workforce, doesn't have sufficient education or sufficient skills or sufficient motivation to produce products and services that can generate enough economic reward for them that they can sustain their lifestyle. A circumstance where the social construct, the contract between the American government, however tenuous that contract may be, and individual Americans, the extent to which that contract got violated simply because there wasn't enough money in the economy to afford the transfer payments anymore would be profoundly ugly. It's something that I hope I don't experience. Mercifully, history has shown that in circumstance where social trust deteriorates, particularly social trust around the purchasing power of instruments denominated in fiat currencies, that a fairly small investment in precious metals and precious metals equities provides sufficient insurance that one is taken care of. If you revisit the arithmetic in the 1970s bull market, at the beginning of that market, gold was selling for an admittedly price-controlled $35 per ounce. At the end of the cycle, it was trading at $850 an ounce. What is that, a 20-fold increase? If 10% of your portfolio generated a 20-fold increase, you could afford a 50% decline in your debt and equity portfolios. If you want a less dramatic example, let's look at the 2000 to 2011 bull market, where the gold price went from $250 an ounce to $1,900. In fact, let's cut that number substantially. The circumstances behind explosive up moves in precious metals generate such extraordinary up moves in the precious metals that the amount of portfolio insurance that is delivered by precious metals and precious metals equities is such that the amount of precious metals that you need to hold in your portfolio relative to other asset classes is small. One of the things that happens when I address audiences like yours is they seem to discount the fact that precious metals bull markets don't, over the course of an entire bull market, generate 20 or 30% returns. They generate 300 or 400 or 500% returns. So while it isn't certain that we are in a precious metals bull market or will enter into a precious metals bull market, I believe that it's likely. And I believe that the upside in precious metals is substantial enough that a 10 or 15% holding in one's portfolio can insure against a 50% loss in other portions of a person's portfolio. And that's the sort of approach that I would suggest for your listeners. In my heart of hearts, if I'm right, and that we're 40% of the way through a precious metals bull market, in my experience, the second half of a bull market is much more dramatic than the front half. And if I'm right, I don't think that the silver price goes from $20 to $30 or $35. I think the silver price could easily, don't put this as a clickbait title, I think it could easily triple or quintuple from here.
Yeah.
I don't think that the gold price would be limited in a move from $1,800 to $2,500. A circumstance in our economy where the arithmetic that we talked about earlier played out in people's psyches means that I could see easily metals prices doubling or tripling. And I could see an intelligently constructed equities portfolio, not comprised exclusively of the penny dreadfuls, but some quality stuff. I could see that portfolio substantially outpacing the gains that one enjoyed in their precious metals. The point of all this is that while the circumstance that we talk about isn't a certainty, it is a strong enough probability, which is a bigger word than possibility, that people would be well advised to have at least enough of their portfolio in precious metals that it hedged or insured around the rest of their portfolio and, in fact, their lifestyle. Go to a website, ruleinvestmentmedia.com, list your natural resource investments, and I'll personally rank them 1 to 10. I'll also comment on individual issues where I think my comments might have some value. And if you mention charts in the question line, I will include in my return email the Barron's Gold Mining Index, which I think is the best pictorial examination of past precious metals bull markets. And on top of that, I'll send a 110-year commodity chart that talks about just how cheap commodity prices are relative to other asset classes going back 110 years. Once again, that's ruleinvestmentmedia.com. The other thing which I'm happy to do for people who respond to the rankings is include information. Many people know that one of the things I'm doing in retirement is backing a team that I backed in the past in starting a brand new bank, which will be very, very, very focused on precious metals. If you include the word bank in the comments, I'll put you on the list to receive information about being a borrower or being depositor in our bank, if you care.